Hi, I'm Chris Cebula, and I'm here today with Nick Russo. Nick is a portfolio manager at Armbruster Capital, which means it's his job to keep an eye on asset allocations, execute trades, and generally make sure that our accounts are in line with their long-term targets. So why don't you tell us a little bit about what you do here at Armbruster Capital?
At its core, it's making sure that all portfolios that we manage are true to their client's specific targets. So when a client signs on board, we establish targets for stocks, bonds, and sometimes alternatives to make sure that the risks in the portfolio are appropriate for that client. And so we use our technologies to monitor each portfolio relative to these targets and make sure that the portfolios aren't too far off from their stated goals. If they are far off from their targets, we'll execute trades through the custodial firms that the money's held at.
What is a custodial firm?
It's Charles Schwab, TD Ameritrade, and Fidelity, all names that everyone listening is probably heard of. We should make the distinction that we're an investment management firm, but we don't actually hold the assets. And we firmly believe that management and custody should always be separated as a safeguard for clients. Many of you may recall Bernie Madoff, who ran one of the biggest Ponzi schemes in investment history. He had both management and custody of client assets. That means he was able to doctor statements and make investments for clients or make fake investments for clients, and his clients wouldn't know any different. An independent custodian allows clients to see exactly what they hold at any time, and the investment manager only has trading authority over the accounts, but they don't have legal authority to withdraw or transfer the funds.
Can you expand on your comment relating to monitoring the accounts at each custodian and then entering the trades? What does that entail?
The majority of the work is done in Tamarack, which is our portfolio management tool. We use Tamarack as a data repository for reporting and modeling trades. And then once that's all done, then we can enter the trades at the custodian.
Maybe you can talk about what a normal day looks like with regards to trading and portfolio management.
I run various reports in Tamarack that alert me to what accounts and portfolios may need attention that day. A client may have deposited a check, a bond in a particular portfolio may have matured and we need to reinvest the cash. We may need to lock in tax losses, or simply a portfolio is off target like we alluded to before.
What does that mean? How does a portfolio get off target?
Let's say a portfolio is supposed to be 60% stocks and 40% bonds, but stocks rise significantly faster than bonds. Now the portfolio might be, let's say, 65% stocks and 35% bonds. This is actually riskier than what the client signed up for. So we'll sell stocks and we'll use the proceeds from those sales to buy bonds and get closer to client targets.
And that's all done through the system?
Yes. So the system is very powerful, and within it, we can model various trade scenarios to help us know what to trade, when to trade, and what any potential tax ramifications may be.
So at this point, you're ready to trade. Do you just put those buys and sells in at the custodian or broker?
I wish it was that simple. There are a number of different types of trade orders you could put in, the simplest of which is a market order, which tells the broker to just buy or sell at whatever the current price is in the market. This effectively guarantees that your order will get filled, but you might not like the execution price. It also puts you at risk of large, sudden movements in the market, like the flash crash in 2010. Most of the time, we have to use either limit orders or algorithmic orders to get our trades done. That means we have to keep a close watch on the trade after it is entered.
Well, what about trading costs? Trading commissions have effectively gone away these days, so at least cost isn't a big part of the consideration anymore, right?
That's not entirely true. We were happy that commissions on stocks and ETFs were reduced to zero, but we still pay commissions on some mutual fund trades. There are also other costs involved. The bid-ask spread is the major one. While most of us see the current price or the closing price of a stock, there are actually always two prices for each stock. The bid is the price that a buyer is willing to pay, and the ask is the price the seller would like to get. For large companies like Microsoft or very liquid ETFs like Spiders, the spread is usually only 1 penny per share. However, for less liquid stocks and ETFs, the spread can add up to 0.5% or even more.
Are there any other considerations when trading ETFs or exchange-traded funds?
Yes, there's one other major concern, and that is the premium or discount to the fund's underlying net asset value, or NAV. This is the value of all the shares held in the fund at any time. For traditional mutual funds, the NAV is only calculated at the end of the day, and all buys and sells placed during the day are done at this price. For ETFs, trading is done throughout the day, and NAV is calculated every 15 minutes. The market price for the ETF is generally very close to the NAV, but again, it depends on the fund you are trading. Some are more liquid and are tighter to the NAV, while others tend to have wider gaps. Volatility in the stock market can impact this as well.
So, in summary, what do we really need to worry about?
At the end of the day, we need to make sure that we not only get our orders filled, but we have to be cognizant of not moving the market with our trades and keeping costs at a minimum so our clients earn the highest possible return.
Changing gears a little bit, you've mentioned taxes a couple times. What are some specific things you actually do to minimize taxes?
Like managing expenses, keeping taxes to a minimum is super important. Many investment managers skip this part of the trading process because it's hard and it involves a lot of individual client-specific considerations. However, it can be one of the most value-enhancing parts of the trading and portfolio management process. First off, we use asset location strategies to make sure we match up investments with the proper account type. For example, if we own a bond fund or an alternative investment fund that pays a high yield, that fund could result in a lot of taxes at the end of the year. Even worse, that income is often considered ordinary income, so it gets taxed at a higher rate than long-term capital gains. So when possible, we'll hold these types of funds in an IRA or other tax-advantaged account. Similarly, we like to hold stocks in taxable accounts so their growth is eventually taxed at capital gains rates rather than at the ordinary income tax rates required when you take the money out of a retirement account. We've set up our system to help us identify any losses in taxable client accounts. When they appear, we'll capture that loss by selling the fund that declined in value. We generally still want to have that exposure to that particular segment of the market, so we'll buy a different yet very similar fund. This allows the portfolio and its exposures to largely remain intact, but it also gives the client the tax benefit of that capital loss. An example would be if we held a fund that tracked the S&P 500 and it declined in value by 10%. We could sell that fund and immediately repurchase a fund that tracks the Russell 1000 index. These two funds both follow large cap US stocks and have very high correlations with one another, so the portfolio characteristics wouldn't really change, but we'd have that 10% loss to help offset income and capital gains in the future.
Thanks for sharing, Nick, and we want to thank you so much for joining us today. That was a great overview of the portfolio management and trading process we use at Armbruster Capital. As you pointed out, we're always looking out for efficiencies that we can bring to the process to help remove those frictions which reduce the returns to our clients. Efficient trading, cost reduction, and tax management are all components of that process, and Nick is the guy who helps make sure that all happens. Thank you for tuning in today. We'll be back soon with the next edition of our InvestED series.